I know I spent a goodly amount of time with a number of you both last night, as well as in some one-on-ones and lots of texting and lots of WhatsApping and lots of sharing spreadsheets back and forth. So I'm okay with all that. Okay, so what I want to do is spend just a few minutes kind of reviewing some elements from the explicit and continuation period, then revenue forecast, expense forecast. So recover some of the ground that we worked last week, because this may bring up some questions for you, or it may just solidify what you've done now within the Excel assignment and such for this week. You have to know that this coming week's problem set, this coming week's practice homework and homework will have revenue forecasting and expense forecasting in it. And then you come down and boil down and use that in some models. And then I want to extend a little bit into these forecast adjustments. Now, this is what I left off last week, okay? And I don't intend at the moment to go very deeply into this. I'm taking out of your various homework assignments and problem sets, etc., the need to do a forecast adjustment, but I want to show you some dynamics and how we might use some adjustments and their value to us. And then we'll move on to some new items, which will be looking at some valuation models, some of which we've already begun to do, and one of which we haven't even touched, okay? So I'm going to ask, let's see, Lisa, would you take the opportunity, if you would, to explain to us this issue of explicit versus continuation period?
You explain it.
Okay.
Don't make me explain it.
That bright red hair eating its Wheaties today?
Mandy, that's you.
Are you talking to me?
Yes. Yeah, what the clue there was when I said Mandy, and the secondary clue was red hair.
I didn't hear Mandy. I just heard has the bright red hair eating its Wheaties.
Okay.
Okay, so from my understanding, the explicit period is like how far out you're forecasting. So in this case, if you're doing 3 years, that you use a certain growth rate for that, right? Because that's what you're estimating or
Okay.
expecting. And then from there on out, that's your continuation period. And so that's something that you don't necessarily want to evaluate, but you want to more so say, okay, I'm putting this at 2.5% or something like the market rate or inflation, because that's what you can expect companies to, and so to grow at after that period. But
Okay.
how far out you put that continuation period is up to you.
I agree with all those things. In this case, for how many years? If year number 4 is the first year of my continuation, for how many years in this scenario will I actually forecast cash flows?
3.
Anybody agree or disagree?
Well, I'm not sure if I understand the question, but isn't the continuation terminal period forecasting infinity?
Well, we are applying we're applying a growth rate to an infinite number of periods, but you've never seen me use more than one forecasted year into the continuation, have you?
Oh, right. Yep. Gotcha.
So Mandy, I would agree that we would forecast out 3 years of our more robust growth and our more explicit or very highly detailed forecast. But in fact, we are, in this case, forecasting 4 years, because we always are forecasting the first year of the continuation. We're just forecasting it at a very nominal level of growth, right? Okay. Why do I have years 5 and 6 here? Should I have years 5 and 6 here? What do you think, Taylor?
I think it is fine conceptually to show that time continues. Not necessarily that we're going to have forecasted cash flow during that time, but that it doesn't just stop at year 4 or year 1 of the continuation period.
And I would tend to agree with you. I would think they have no purpose in this scenario otherwise. Okay? Any question about this issue of explicit and continuation period? I know that a couple of weeks ago when I first introduced it, it was very foreign to you and counterintuitive. Any question about it at this point? Michael Allen, are you comfortable with it? Okay. All right. So let's look at expense forecasts. I think now you're probably pretty comfortable with how you do an operating expense forecast. You create a ratio, which is going to be the operating expense category divided by the revenue for that year. And then in order to turn that into a model, you take that ratio times the revenue for whatever year you're forecasting the expense for, and it gives you that particular expense. And you've now used this in the Excel assignment that you've been working on, okay? So if we know the revenue and we know the ratio, we know the expense. And we know the revenue projected for the year that we're targeting. We now know the expense for the year that we're targeting, which makes sense. And we then also have this slightly different structure for interest. The forecast ratio for interest is the interest paid at one point in time divided by the debt balance from the prior point in time. Why do we have this temporal shift? Why are these not both for the same year? Diana, any idea?
It's like the credit card you said last time. We always pay for the previous month.
Yeah, we tend to pay interest on the debt balances in arrears. It's just the way we conventionally do it within our financial society. Okay? Do we need to forecast interest expense or debt for that matter in order to forecast free cash flow? You're shaking your head, Matt. You don't think so?
I'm just thinking about the components to calculate free cash flow, and I don't remember debt or interest being part of it.
And you're right, it's not. But if my company owes money, have I not already committed some part of our cash flow so that that part is no longer free?
But didn't you do that on the income statement?
Well, the income statement, the interest expense comes after EBIT, and we're using EBIT times 1 minus the tax rate minus net capital spending minus change in net working capital. So you were right. It's not reflected there. Why do I not have to include it then?
Does it have something to do with discretionary reasoning?
Everything to do with discretion. It has everything to do because it's not a required function of the operation, and we're valuing the operation. It may be a required function of the commitments I have made from operational capital, but it's not a function of the operation. And
meaning that you're not required to take on debt and pay interest on it. Yeah. That's a decision. You may decide to finance the company that way, but
I could have financed it through equity, right?
Sure. Okay.
I could have financed it by pulling the money out of my savings account if I had one. I could, it's all a function of discretion. And remember that the components of free cash flow, we have tried to strip away any of the financial elements that are reflective of discretionary choices on the part of the business management. Because if Kylie buys this, she may finance part of it, but if David buys this, he's got enough money sitting around, he doesn't have to finance any of it. It's discretion. So that might beg the question, well, wait, Kylie's going to manage it differently than David is, right? Well, that's probably true, but in a competitive market with managers trying to manage to optimality, they shouldn't be managing it much different to get the optimal outcomes from the asset. Okay. So we talked then a little bit about scale assumptions. And I'll bring up the spreadsheet in just a minute, because this is a place where I think some of you might still have some concerns. But we talked about scale assumptions and scale economies. And I introduced two ratios, an invested capital to revenue ratio and a debt to invested capital ratio. So let me go ahead and bring up Mira Dravana's spreadsheet. Michael Allen, what is the purpose for having introduced these two ratios, debt to invested capital and invested capital revenue?
Is it that it
Anybody can step in here and help.
It's used to forecast debt.
So why do we need to forecast debt in order to get to free cash flow, since interest expense isn't part of free cash flow? We kind of don't, do we? Now, you're right. We are using it to forecast debt. Okay. And we're going to see tonight why we need to forecast debt. But it's not part of free cash flow. So that's not the reason. I'm trying to make sure in imposing these conditions that we maintain a strict, constant returns to scale environment. If I don't impose these conditions, then you would find that return on invested capital would be changing, not just one time, but every time. And it's not necessarily that that's bad. It just violates our simplified conditions here. And we're not going to move in this particular course to a constant returns forecast. It's enough more complex that I don't want to do it to you. Okay. If you guys get to the point where you're working on your capstone projects and you need to do some forecasting and you believe you're in an increasing returns environment, you're more than welcome to reach out to me and I'll help you with the tools to forecast increasing returns, or if need be, decreasing returns. Okay. But in this class, in this 7 weeks together, we're not going to go there. All right. These two ratios can be models, and you've already used them to forecast debt, and you may have used them to forecast invested capital. And you'll remember that sometimes I put an additional invested capital column in my forecasts where I'm using the ratio in this column where I did not use the ratio in this column. Why do I do that? Bella, any understanding, any recollection why I do that?
Not. The only thing that I can think of is, yeah, I don't know.
Okay. Kate, any recollection why I would have that twice?
You're asking the invested capital?
Yeah, why have I gone ahead and given myself a second invested capital column?
Double checking.
Double checking. Have you already realized that there's enough complexity in these that it's easy to screw one of these things up?
Yes.
Yeah. So the more check digits that I have, the happier I might be. Okay. And so this, and I happen to just have given you guys this one. All right. So we know how to forecast revenue. We get together, we look at the market that we're in, we look at the macro economy, we look at our customer orders, we look at innovations, we look at products coming down the pipe, we look at the expansion plans of the company, we look at whether or not we're capturing more of the market than other companies of our size. We look at all of these things and we come up with a number. And we probably don't come up with that number and say that number is going to be good for each of several years. We probably come up with that number for every year, or maybe we come up with a number for every calendar quarter. But if you have come up with a number once, you can use that same methodology to come up with another one and another one and another one, and you can figure out how to apply them. for simplicity's sake, I just come up with one of them and I have you apply it to the entirety of the explicit period. Okay? But know that if you were doing this in reality for your complex organization, you would at worst be doing this on an annual basis. So you'd look at this for every one of the next several years, or you might be a little more anal than that, and you might do it for each quarter, because we tend to look at measurements in quarters more than we do months and more than we do years when it comes to this kind of thing. And then if I've got a constant return scenario, I'm also going to look at my forecast ratios. And I think that you're probably reasonably well attuned to this now that you've had to muddle through the Excel assignment. Any questions about what we've got going on here with the forecasts? Okay, so I want you to pay attention. I want you to note that we have come up with one of our valuations using the free cash flow model, and I'll come back and spend some time here, of course, but it's about 601, 601.4, okay? Michael Allen, you and I, as it turns out, are a pretty good management team. And as a good management team, we've decided to buy this company. And the company has a valuation of 601. And we know that the owners are not going to budge off of that 601. They're not coming down. In fact, we know more often than not, if we try to buy an asset, especially one if the stock is in the public market and we want to buy all of it, in order to do that, we're going to have to pay more than the valuation is established at. Taylor, any understanding why we are likely going to pay more than the current outstanding value of the stock if we're buying a company in the public markets? It's okay if you don't.
I don't.
Okay. So Shenzhen, I think you know that most of the time when a company has a tender offer or purchase offer and is publicly held, we end up seeing those companies go at 10%, maybe even 25% more than the current market value. Do you know why that is?
Actually, I don't know.
Okay. So I'm going to pretend, Shenzhen, that you are one of the shareholders. Okay. And there's 5 of you. Michael Schwartz, Carol, you, David, and Lisa. And Lisa, I've put an offer out for this company and I want to buy its outstanding stock. And I come to you first and say, Lisa, you got stock worth X per share. I would like to buy your stock from you. Are you probably comfortable with me giving you the market value based upon the last trade in the market today?
I'd say yeah.
Okay, and I would think you probably would. Okay, David, I come to you next. Lisa had 20% of the stock. You have 20% of the stock. So do the others, by the way. I'd like to now buy your 20%. Are you going to be willing to accept the same price I gave to Lisa?
I want a premium.
How come? Lisa, its last market price was what I paid to Lisa. Why do you want a premium? Or why do you think you should get a premium?
Because I think it's more valuable than what the market does.
Well, that doesn't surprise me. I mean, you have a history of looking like you think you know things other people don't know. But that's not that satisfying. There is an argument you might make, though, that could be satisfying. I'm going to move to Michael Schwartz for a minute. Michael, are you going to be willing to accept the same price I gave to Lisa?
No, and I'm maybe not going to articulate this well, but there's value in owning even more of that company that's beyond just the actual value?
Well, I think yes, that's true. And that's frankly what Dave is trying to argue as well.
Okay.
Here's a point that I'm trying to get at, and you guys will all understand this. Once I took Lisa's shares out of the market, the available shares became more scarce, right? And when something is more scarce, what happens to its price, Mandy? Goes up, right? Okay. So David, that's the argument that you make. Because you're not going to win the argument any place other than maybe your own home that you know more than the market. Oh, you may well be right, but the market's a big enough beast that you're never going to argue against the beast, right? But you might argue that the moment that I bought 20% of the outstanding shares from Lisa, that it made the remaining shares more scarce, and more scarce shares are worth more money. And so, Michael, you'd have that same argument. Carol, you'd have that same argument. By the way, I hope you're feeling better, Carol. Shenzhen, I now finally come to you. I own 80% of the stock, and the only thing standing in between me and 100% is you. I had to pay $10 a share to Lisa, and by the time I got through Carol, I was at $11.50 a share. How much are you probably going to charge me per share to buy the remaining outstanding shares of stock?
I think I'll pay more.
Yeah, and I'm proud of you, you capitalist pig. Okay? Because of course you're going to make me pay more. If I want it bad enough, and you're the only thing that stands in between me and getting it, you're going to make me bid up. Well, this is a problem for me because I see the company's only worth 600. And I just paid, with our little discussion here, I paid more than 600 for it. Am I going to end up with a negative net present value? And have I just shot myself in the foot? What do you think, Diana?
I think it's going to be the negative present value of
You have little faith.
Huh?
So now I'm coming back to my hit person, Michael Allen. Because remember, she and I are the dynamic duo. And now that we own this company, we believe that we can make some adjustments to it. In fact, we knew this before we went ahead and paid you guys more than it was worth. In fact, we ended up paying you like $700. Okay? More than it was valued at. And I'm going to tell you that we're going to walk out of this with a nice, and I mean nice, net present value. Michael?
How do you know that they paid 700? I don't see 700 anywhere.
I just came up with it off top of my little head. I looked at how much all these usurious people charged me, and I decided that the whole sum of this experience was they charged me 700 for something that was valued at 600. And I willingly did it. Michael, we're going to wrap this company into our existing conglomerate, are we not? And we're going to sell some of this company's products and services to our marketplace that's not buying from them at the moment. And we're going to introduce some new products in such that I think we can improve our revenue by 5% just because of the added value that we bring as owners and the network and our customer base and our innovations, etc. Do you think that's a fair number? Yeah. In fact, I remember earlier you were trying to convince me to do it at 10%. I just wasn't that bold. Okay. And we've gone to Bella. Bella is our head of production and service, and she's the one that has been negotiating all of our contracts. And now that Bella is part of a much larger company that buys a lot more products and services, Bella has come to us and said, now that we're part of this bigger conglomerate, we can get better pricing. In fact, we can get 2% off what we're currently paying in our pricing on production and service. And Andrew deals with all of our fixed equipment, and he knows what we can do. Not only that, we can do a little bit better than that. We can get about a 3% benefit. And we've come to Kate because Kate's all about marketing and the truth well told. And Kate knows that with these huge ad buys we can do and working with our Madison Avenue and Palo Alto companies here, that we can get maybe a 2% improvement on our marketing and sales costs. And I happen to know that I'm the CEO of this whole company now. We don't have to pay me and pay the CEO that was in this company, and we don't need another CFO. So we've got some economies of scale here. We don't need to pay management in a redundant way, so we can get about a 2% savings here as well. Do those seem like unrealistic expectations for a management team with the prowess that Michael Allen and I bring to bear? I mean, it's 5%, it's 2, 3%. Mandy, would you venture a guess as to what kind of change has come about based on these adjustments? What kind of change in valuation has come about?
I won't.
Kylie, you want to venture a guess? Wimp. That was for Mandy, not you, Kylie.
No, it's good. I would think that if you have all of these, benefits, then it would work in your favor.
Well, certainly we're going to see a higher valuation, right?
Yeah.
Would it surprise you that we went from 600 to 788? Now remember, the biggest change we made was a 5% change, but we just saw a 31% increase in our value just by bringing some improved selling, some cost cutting. And remember, I paid 700, and I told you guys when I paid the 700, that Michael Allen and I were going to end up with a nice, big, fat net present value. And if we paid 700, Michael Allen, what's the net present value that we're going to get from this company?
We're going to get, what is that, 788?
Well, that's going to be our value. That's the value.
Mm.
So now we're going to net out the 700, so we get an $88 million or an 88 net present value, which means we're going to make that much more than the discount rate of 14.5%. The technical term for this, Michael, is score. All right? Okay. This is how companies in the markets can end up going for premium prices, and the entities that buy them still do just fine. Because I'm not going to buy Mira Dravana Enterprises if I think I can't improve its outcomes. Right? I'm only going to buy it if I can improve its outcomes. So the dynamics of these adjustments are small adjustments in these. I mean, what's the average here? 3%? Maybe? In fact, I'll even take this thing down to 3%. And I still think I win. Right? So the adjustments are dynamic. And if we get time before the last night of the class is over, I'll go through and talk about the modeling of these adjustments, because it's more than just putting a number here. It's how you have that number interact with all of the formulae that we have inside of these. Okay? Any questions about this?
Yeah, actually, I have. Can you remind me that forecast ratio, like on that line right above adjustments? That's talking about. Is that through each year? Oh, it's.
Yep. So Michael, when we create a forecast ratio, unless we're going to make an adjustment to it, we're going to suppose that that ratio is constant. And the ratio is going to be the expense category for the base year divided by the revenue for the base year. That gives us a ratio.
Right.
And
Okay.
we apply the ratio to find the new expense. Because
Gotcha.
if expense divided by revenue equals ratio, then revenue times ratio equals expense.
Okay.
So now it's a model. It's not just a ratio. It's a model when we rearrange it like that. Okay.